Bill Lee joining us right now. He's the chief economist over at the Milken Institute and formerly served as a senior economist at the Federal Reserve Bank of New York. Bill, always great to talk to you. And I do want to start there, specifically when it comes to, I guess, kind of what failed SVB. I know a lot of people will point to monetary policy tightening, et cetera, but there fundamentally was some degree of risk management or lack thereof. And I'm curious as to whether you think this is something just very specific to this one particular bank, or is this something we should be looking at all the banks and maybe just saying what else is there, what is being done?
I think the message that has to come across is that the SVB failure is a failure of risk management. It's banking 101. Banks are supposed to manage the liabilities and assets in a way that allows for deposit withdrawals in an orderly fashion. The fact that deposit withdrawals became disorderly, is because people got wind of the fact that the executives at SVB were not doing their jobs. They were not managing their risks properly. And I think that's something that the supervisors should have caught. And I think I'm very glad the Fed is doing an investigation as to, how is it that all of these supervisors at the state level as well as at the Federal Reserve of San Francisco missed the lack of risk management.
That is the big question here, particularly in an environment, Bill, where we know, or at least we know now, that there were a lot of investors out there that had got wind of this, apparently before the regulators, and started shorting that stock as well as a few others. So I am curious as to why you think that investors were able to find publicly available information that gave them alarm, but all of the regulators who in theory would have had access to the same information before those investors didn't necessarily raise the alarm.
Well, from the perspective of an East Coaster, I would like to think that a lot of the people in Silicon Valley are subject to groupthink. SVB was doing all this cool stuff of financing high-tech investors and allowing an ecosystem to develop within that community. And I think that they started to look aside at all of the sins that SVB was committing because of all of these blessings that they were giving the community. And I suspect some of the regulators in San Francisco Fed and at the state regulatory board may have been lulled into that same kind of lenient culture.
Okay, there is definitely a different narrative depending on whether you're on the West Coast or on the East Coast. I wonder then, given what the Federal Reserve did with FDIC and Treasury, did they create moral hazard by making whole all of SVB's depositors, many of whom are corporates and also VC funds?
One of the principles behind FDIC insurance is that it's there to protect the little guy, and part of the regulatory oversight is supposed to come from the private sector. That is, people whose money is exposed to risk are supposed to be much more careful in where they put their money, and by doing that, will have do its due diligence and have supervisory oversight over the behavior of the bank executives. That apparently failed, or the bank executives were able to bribe the depositors into keeping their money there by giving them all other bennies.
Right. Okay, I see what you're saying. So what does this mean for corporate customers, corporate depositors that have more than $250,000 stashed away at other regional banks that the stock market has decided to punish in the last couple of days, whether those banks are First Republic, Western Alliance, or Zions?
When I was at the IMF, we wrote the Global Financial Stability Report, and issue after issue, we had the same message, which is do your due diligence, that the people who are doing investments either into emerging markets or into financial institutions, or even something simple like putting a lot of money into a bank, have got to make sure that they understand where their money's going and what they're doing with their money. And so due diligence really is the key part of market surveillance, which has broken down. And right now, people just got a rude awakening as to how that's going to affect their lives in the future. And the Federal Reserve also has got a rude awakening because regulatory policy of preserving financial stability is a trade-off with monetary policy and inflation fighting. But in this case, we do not have a systemic run on the bank. We have a case of a couple of bad banks in the crypto world, in the tech world, that were lulled into bad risk management practices. We don't have a systemic bank run crisis.
Well, then I'm curious then, with regards to the Fed's efforts to, I guess, continue this rate hiking cycle in the interest of fighting inflation here, is there an argument to be made? Is there finger pointing to be had at this tightening cycle and maybe make a case that maybe it should at least pause?
Romaine, the other message we had at the IMF was the dangers of mark-to-market accounting. There are some parts of asset portfolios that should be mark-to-market so that you know exactly what something is worth at any moment in time. But in the case of a bank where they have loans and securities. Isn't it sort of weird that a bank with a lot of loans out there don't mark their loans to market, but the assets, the securities like treasuries, are marked to market. So the mark to market portion induces a lot of volatility, and whereas the non mark to market loan portfolio, which is even more at risk, is not a source of volatility.
Yeah.
And volatility, by the way, Scarlett, if you remember, is the one thing that stops the Fed from tightening. Volatility in the financial markets is the one thing they really stop dead over. And right now, the kind of volatility we have is not systemic.
Okay, and the volatility, at least for now, seems to have stemmed. Bill Lee, really appreciate your joining us. Bill Lee is chief economist at the Milken Institute on the West Coast.